Right. Welcome to Scholars and Associates. Tonight, we'd like to look at financial instruments. Financial instruments, which is IAS. Is it 32? Yeah, IAS 32. Then IFRS 9, right? IFRS 9. So, what is a financial instrument? What is a financial instrument? So, a financial instrument is all right. So, what is a financial instrument? So, financial decrease the font size. Okay. All right. So, financial instrument. Financial instrument. So, what is a financial instrument? We said that the financial instrument is a contract. So, is any contract? Is any contract that gives rise to a financial asset of one entity, financial asset of one entity, and a financial liability or equity of another entity, right? So the financial instrument can be an asset to one entity or one party, and then it will be a liability to another party. So example can be maybe a loan, right? A loan from a bank, whereby the bank giving out the loan would see it as an asset, right? Would see the loan that they are giving out as an asset, and then the issuer or the one taking the loan would see it as a liability, right? So financial instrument gives rise to a financial asset and then a financial liability, right? A financial asset and then a financial liability. So what do you mean by, or maybe equity, right? Equity to the other entity. Equity is basically the residual interest, the residual interest. So what do you mean by a financial asset? What is a financial asset? So a financial asset is any asset. A financial asset is any asset that is what we know what an asset is. So that is, let's say, it can be cash. Cash is a financial asset. What else? A contractual right. A contractual right to receive cash. You have the right to receive cash. or maybe any other financial asset, right? And let me say, yeah, sometimes equity instruments, right? So the financial asset is a cash or a contractual right to receive cash, or maybe equity instrument. So let us look at some of the examples, some of the typical examples of financial assets. So some examples, examples of the financial what assets, financial assets. So you can say investment. When you have investment in ordinary shares in equity, right? Investment in ordinary shares. When you have shares in an entity that is a financial asset, and then you can also invest in debentures, investment in debentures, or maybe a loan, since it will be an asset to the bank, right? So the loan can be an asset to the bank, as I stated earlier. So investment in debentures, investment in debentures, or maybe loan stock, right? Then we can also have trade receivables, whereby you give out your goods on credit, right? Trade receivables, right? Okay, so that is basically some examples of the financial assets. Some examples of the what of the financial what assets. Some examples of the financial assets. Okay, so now let's look at the financial liability. Financial liability. So for financial liability, so that is any liability that is a contractual what obligation. So liability is what an obligation. You have an obligation to say, let's say, deliver cash or another financial asset, or another financial asset, another financial asset to another entity, right? Right, or to exchange financial instrument with another entity. So it's basically an obligation, right? An obligation to perform something. So let's look at some of the examples. What are some typical examples of the liability? So we have trade payables, right? And redeemable preference shares, right? You know that sometimes the preference shares are seen as liabilities, right? And then the issue of debentures, it can be a liability, it can be an asset, right? One party will be saying it as an asset, and the other party will be saying it as what? As a liability. So issue of debentures here again, or maybe a loan stock, debentures or loan stock, right? Right, okay. And then, so yeah, that is it. So the equity instrument will be the residual, right? We know asset minus liability is equal to equity. So the equity is the difference. That is the residual. So equity, the equity instrument is the residual. So equity instrument is any contract that evidences a residual what? Interest. A residual interest in the what? In the assets of an entity. In the asset of an entity after deducting all liabilities. After deducting all liabilities. After deducting all liabilities, right? Okay. All right. So now let's look at the recognition and measurement of the financial um, instrument. Recognition and then the what? The measurement. The recognition and then the measurement. The recognition and the measurement. Recognition and the measurement. So, so our focus will be, let's start with the financial liability. Financial liability. So what is the recognition and measurement criteria? Recognition and the what? The measurement of financial liabilities. All right, so the initial recognition. What is the initial recognition? So the initial recognition is one, if the financial liability, so if the financial liability, if the financial liability will be measured, if the financial liability will be measured at fair value, if the financial liability will be measured or is measured at fair value, then any transaction cost, right? If it's measured at fair value, through P&L, fair value through P&L, so profit and loss, through profit and loss, the financial liability will be measured or is measured at fair value through P&L, right? Then any transaction cost, any transaction what cost should be what? Expense. Any transaction cost should be what? Expense in the what? In the P&L, or expense to the P&L, right? Secondly, so this is if it's the financial liability is measured at fair value through P&L, then any transaction cost should be expensed to the what? To the P&L. Also, if the financial liability, will not be measured, so this one is not, will not be measured, not be measured at fair value, through P&L, so that is profit and loss through P&L, and any transaction cost, should be deducted, should be deducted, from its carrying amount, from its what? Carrying what? Amount. So this is the initial what? Recognition. Initial what? Recognition of the financial liabilities. Financial what? Liabilities. This is the initial what? Recognition. Let's look at the subsequent measurement. What is the subsequent measurement? The subsequent measurement will be one at the amortized cost. The amortized cost. Do you remember amortization? Amortization from businessman. Those who did businessman, amortization. The amortization schedule. So the subsequent measurement will be at the amortization cost. Amortization cost, right? The amortization cost. So how the amortization schedule? So that is the table is the year. You have the year, the opening balance, unless the balance brought down. The balance brought down, the effective interest. Then we have here is coupon. The coupon paid, and then the balance CD, the closing balance, right? So we can have year 1, year 2, year 3, dot, 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 dot. The effective interest rate will be on this amount, right? Will be on this amount. So the effective interest rate, and the effective interest rate is on the capitalized amount. That is, after you have done your adjustment, right? After you have done your adjustments, if there is no issue cost, then that is the same amount. The effective interest rate is on this amount, and then the coupon paid is always on the face value or the nominal value, right? The coupon paid is always on the face value or the nominal value. So the coupon paid will reduce the amount, the loan amount plus the interest. So the balance will come here. This closing balance will be the beginning balance here, right? And then you compute the interest on this. The coupon payment would be constant throughout, right? And then you deduct, you get this closing. This closing becomes the opening. You compute the interest on it. So that is how it goes. Okay. All right. So Now, the effective interest rate, this effective interest rate will go to the P&L as a finance cost. So it's good to go to P&L as a what? Finance cost. This coupon payment would go to the cash flow statement, and then the balance carried down will go to the statement of financial position. The statement of financial position. So that is how we present it when you are on the page of the financial statement. On the page of financial statement. All right. So without wasting much time, let's quickly take the first illustration and then move on. So let me see. Someone should read illustration one.
Okay, please, I'm reading. Example 2. Okay. A company issues 5% redeemable preference shares at their normal value of 10,000 Ghana cedis. The preference shares are payable at a premium of 1,760 Ghana cedis after 5 years. The effective rate of interest is 8% required. Explain how the instrument should be classified in accordance with IAS 32 Financial Instruments Presentation. And then what amounts will be shown in the statement of profit or loss and statement of financial position for the years 1 to 5.
Okay, so thank you very much.
You're welcome.
All right, so this is financial instrument. So they're asking us how this will be classified under financial instrument presentation. That is IAS 32, right? IAS 32. All right. So measurement, you are going to use the amortized cost, right? You are going to use the amortized cost. All right. So you've been given the nominal value. The nominal value is the same as what? The face value. The nominal or the face value. The face value is how much? That is 10,000, right? And there is no issue cost, right? There is no transaction cost, issue cost. So what will be the amortized cost? That's the face value of the preference shares, right? Which is the debt. So I'm using the amortized cost. We have the year, the balance brought down, the effective interest, the coupon paid, and then the balance brought down, or the closing balance. Sorry, the closing balance. The closing balance, right? Okay, so they said from year 1 to what? Year 5. So year 1 to year 5, 4 and 5. Usually, I don't think you'll get a question more than 5 from year 1 to more than 5. That will be a lot of work. That will be a lot of work. So now, what is the debt? So the debt is 10,000. The debt is what? 10,000. And then the effective interest rate is what? 8%. You've been given the effective interest rate here as 8%. So the effective interest rate is 8%. And then when we give the coupon interest is what? 5%. the coupon. He said a company issues 5%, so that is the coupon payment or the coupon rate. So 8% on the 10,000 is given us how much?
800.
800.
800. Then the coupon payment 5% on the face value, which is still 10,000, is also how much?
500.
So that is 500. That is the same amount to be paid throughout the year. 500, 500, 500. Then the last year will pay the face value plus the interest, which is the 500. All right. So from here, 10,000 plus 800 minus 500. What will be the balance at the end?
10,300.
10,300.
1,300. Right. So this will be the beginning, 10,300. Right. And again, note that this is at the end. When the question is silent, it's at the end, right, and not at the beginning. So if it's at the end, this is how you present it. But assuming it's in advance, then there will be a little change in the format. There will be a little change in the format. All right. Where you would make the coupon payment. When you make the coupon payment, the total amount left, that's where you compute the effective interest rate on. So assuming it's in advance, the coupon payment will come here, will move from here and then come here. So you deduct the coupon payment, then the total that will be left before you compute the interest on that. So the interest will rather come here and the coupon will come here, right? So that is when it's in advance. This is at the end. When the question is silent, we assume that it is at the end. So the 8% on the 10,300 is given as how much?
824. 84.
824. So this plus this minus this, what do you have?
10,624.
10,624. So this will be the beginning here. 10,624. Interest on that is given as how much?
849.92.
849.
Yes.
8% on this. What do you have?
849.92.
Point 92. Did I hear 92?
Yeah.
Okay. So what is the final answer?
$10973.92. 973.92.
93.92.
Yes, please.
Okay, so that would be the amount here. 1097.92. Compute the interest that you have.
877.9136.
So what did you get? What did you get?
876.91.
7
7.9136.
9, right? Mm-hmm.
Yes, please.
Mm-hmm. So then what are we getting here?
11351.
Please.
1,135,1.83.
0.83.
Okay, so that will be the beginning here. 7351.83. What's the interest on that?
908.15.
908.15. Okay,
Yes, please.
and the interest.
Please, I've been doing it 2 decimal place. Is that okay?
Yeah, you see, it's prudent to leave it in 3 decimal place. It's prudent to leave it in. This one, I even wanted to do it in a whole number because this one will not be using it for anything. I'll be using it in interpretation of, so I just use it for. I wish we could even do it a whole number. No problem. No problem. Okay, so at the end of the period, we are going to pay 0, right? You should be able to pay the loan amount, right? At the last year, it should be 0, right? Right? So add all of this. Add all of this. What are we getting? This plus this plus this plus this.
11759.98.
1,
Please, I've subtracted the 500 already.
with 500.
The coupon page. Or I shouldn't subtract that one.
Which one are you talking about?
The balance brought down plus the effective interest minus the coupon. That's the value I'm giving right now.
Minus the 500. Okay, so what are you getting?
11759.
759.98.
0.98.
Can you run this one to the nearest whole number?
11760.
11760. Right? So at the end of the day, it means we have paid this amount, right? We have paid this amount. And that it means we have paid the entire amount. So that will give us 0, right? That will give us 0. So how much is the total debt or the nominal value? How much is it?
10,000 Ghana cedis.
Yeah. With 10,000 Ghana cedis. At a premium, how much is the premium? How much is the premium? From the question. At a premium of what? 1,700.
760.
1,700 will give us the amount 760. So this is informing us that whatever we have done is correct because they said they are paying that nominal value at a premium and the premium is 1,760. So it means the 10,000 plus the 1760 should give us the 11,760, and that is correct. That is correct. So the 1,700 premium they gave us, we are not going to use it for anything. I'm just using it to ensure that whatever we are doing is correct, right? So that the premium. So now let's present the following on the statement of the financial position, the position, and then the P&L. So starting with the P&L, how would the P&L look like? So the statement of the P&L. So the P&L, we have year 1, year 2, year 3, year 4, year 5, right? Year 1, year 2, year. So we have the finance cost. I told you that the effective interest rate will be the finance cost. So what is the effective interest rate? So the whole of this will be for the P&L, right? And then this will be for cash flow, and then this will be for the statement of financial position. So on the P&L, how much is for year 1? How much is for year 1?
800.
Year 1 is 800. Year 2, 824. 3 is 849.92. And then 487. Someone is giving me feedback. Mute yourself. So, and the last year is what? 908.15. Right? This will be on the statement of financial position. On the statement of financial, statement of the P&L. Statement of the P&L. Let's look at the statement of the financial position. The statement of financial position extract. All of these are extracts, right? So the extracts. So it's a liability. So you have the non-current liability. Non-current liability, right? So how is the non-current liability? The non-current liability means that it goes beyond one period, right? So we have the 5%, 5% preference shares, redeemable preference shares, 5% redeemable preference shares, and for year 1, year 2, year 3, year 4, year 5, right? So for year 1, how much is it? How much is it for year 1? Non-current liability.
10,300.
So these are the values for the non-current liability. These are the values. These are the values, right? So we have 10,000, 10,300, and then year 2 is how much? 10,624. Year 3,
10,973.92.
10,000. Nine seven what? Let me make it 4. 10,097. 10,097. 974. I've rounded it, right?
Okay.
Then what else? Then the year 4 will be how much?
1135.
35 or 2. That one, so I'm making it, right?
Okay.
But year 4, remember it's at the end of the period. All what you're doing is at the end. So at the end of year 4, you'll be paying 10,000. 10,000, how much? 10,000, sorry, 11,352. 11,352 at the end of year 4. Means we just have 1 year, right? We just have 1 year, which is year 5 to pay, right? Right?
Yeah.
Yeah, so since we have 1 year, then it becomes a current liability. It becomes a current liability. So 5% redeemable preference shares. So that's year 4, which is 11,352. 11,352. For this one, at the end of year 1, you still have 4 years. Year 2, year 3, year 4, year 5. So it's a non-current. For year 2, at the end of year 2, 10,624, you still have 3 years. So 1, 2, 3, that is still a non-current liability because it goes beyond one financial year. For year 3, you have 10,997 payment to make. You have 2 years, year 5, year 4. 4 and 5, so that is also a non-current. But for year 4, at the end of year 4, you have this to pay. You just have 1 year. That is a current liability. That is a current liability. And then at the end of year 5, you have zero payment. You have zero payment for year 5. Zero payment for year 5, right? Okay. So now that is it for the P&L and then the statement of financial position, statement of financial position. Illustration 2.
Please, we also capture the coupon paid?
Coupon paid. That is for the cash flow, and we are not required to prepare cash flow.
Okay. Okay.
IAS 30, is it 7? Sorry, IAS 7, cash flow statement. So the coupon payment is for the cash flow. All right. So illustration 2. Is that Savior? The one who spoke, is that Savior?
No,
Who is that?
Beatrice.
Okay. So let's read the illustration 2.
On 1st January 2021, James issued a loan note with a 500,000 cedis nominal value. It was issued at a discount of 16% of nominal value. The cost of issue were 2,000 Ghana cedis. Interest of 5% of the nominal value is payable annually in arrears. The bond must be redeemed on 1st January 20x6 after 5 years at a premium of 4,611. The effective rate of interest is 12% per year required. How will this be reported in the financial statement of James over the period to redemption?
All right. So James. All right. So now we're given nominal value, right? James issued a loan note with a 50,000 nominal value, which is the same as the face value, right? This was issued at a discount discount, right? So the discount of the nominal value, so you have to let the discount from it. Then the cost of the issue was also 2,000, right? Interest of 5% of nominal value is payable annually. So that is the coupon rate, right? The coupon rate. And the bond must be redeemed 1st January, right? So we issue the bond at 2021 and then at 2016. So that is basically 5 years. No, I think 2026, yeah. 2026, yeah. So after 5 years, as it has already been stated. So it's 5 years. At a premium of 4611. 4611, right? Effective interest rate is given. How would this be reported in the financial statement of James, right? So now let's compute the capitalized amount. Let's compute the capitalized amount. So the face value or the nominal value. The nominal value is how much? 50,000. And then this was issued at a discount. So less the discount. Less the discount. The discount is how much? 16%, right? So 16% of 50,000 is how much?
8,000.
So that is 8,000. And then the issue cost, right? The issue cost would also be less. The issue cost. When you are going for a loan from a bank, they'll be like, this is processing fee, this is this and that. Let's say they are giving you 50,000. They will not give you the entire 50,000. They will they will say this is for the processing fee, this is for the something fee. They have a lot of fees. By the end of the day, you will not get the actual amount. But then the interest will be computed on the total amount that is the face value, right? But you would not receive the full amount. They would have deducted all their transaction costs, all their processing fee, and the rest. So the actual money you receive is lesser than what you are actually paying interest on. So the issue cost is how much? 2,000. So how much do we have? Yes, how much is it?
40,000.
Hey, please hurry up. Oh. You want to solve more questions? You see,
Okay.
it's getting late.
Yes, sir.
In fact, I will leave it for you to go and fill the space. So this is the capitalized amount. Capitalized amount, right? This is the capitalized amount. Let me add this note. Note, effective interest is on the capitalized amount, right? Effective interest is on capitalized amount, and then the nominal rate or the coupon rate, nominal rate, and I say let's say face value rate is on the nominal. It's on the nominal or the face value right? All right. So from the first question that we saw, there was no issue cost, there was no discount. That is why you saw that the effective rate was still on the 10,000. That is, it was still on the 10,000. Assuming um, there was an issue cost, or a discount, we would have deducted it from it, and then the effective rate would be on the remaining amount, the capitalized amount. But then the coupon rate is always on the face value, so it will always be on the 10,000. So let us look at how we are going to do it. So now let's prepare our amortized cost. Amortized cost. Amortized cost. Amortized cost. With the amortized cost, we have the year, we have the balance brought down, or the opening balance, and then the effective interest. We have the coupon payment, and then we have the balance carried down, or the closing balance. So for year, how many years? Today we should prepare for how many years? So that is for 5 years. So 1, 2, 3, 4, 5. So what is the balance brought down? The balance brought down is the capitalized amount, 40,000, because the issue cost and then the discount. So we are having the 40,000. That is the capitalized amount, right? That is the capitalized amount. Effective interest is on the capitalized amount. So what is the effective interest? 12%. And then this is how much? 5%.
Please, the effective interest, I think, is 16% rather.
Effective, no, with 5%. Where is it? Is it not this?
Please,
Of course,
16.
issue cost 3,000. Interest of 5% of the nominal value. Face
Please, I'm
value.
talking about the effective interest.
Effective interest rate. The effective rate of interest is 12%. Can you see that? The 16% was for the discount.
Okay. Sorry.
Yeah, it
Thank
was
you.
for the discount. Yeah. Okay. So the effective rate on the capitalized amount. What is the effective rate on the capitalized amount? Hurry up.
4,800.
4,800.
4,800. Then the coupon payment is always on the face value, or the nominal value.
2,500.
2,500.
2,500. And then the balance. So the 2,500, let me write it out on 2,500.
Yes, Dad.
We paying the same amount throughout.
How is?
Yes, what are we getting here?
42,300.
42,300. That will be the beginning year. 42,300. Effective interest on it.
$5,076.
5,076. Deduct and deduct. What are you getting?
4,4,876.
4,4,876. So that will be the beginning. 4,4,876 times the 12%.
5,385.12.
Run, mommy, for mommy food finish numbers.
85.
5,385. And 11 is what I do.
₿47761.
47761. So this will be the beginning. 47761. The interest. So someone should be
Five
verified. If it's
five
wrong, I'll continue like that.
5731.
5731 minus this.
50992.
50992.
Yes, please.
That will be the beginning. 50992.
6119.
6119.
Yes,
To
please.
deduct at the end of the period, you will pay 0, equivalent to 0. Right?
Yes, please.
Yeah, so what will be the amount?
51380.
51380.
3.
Right? 51380. Is it plus? So this is equivalent to the first one that we saw, right? So we add if you add the 2,500, how much I get?
Is it? I did hey, sorry. 50992 plus 6119 minus 2500. Please, sorry, it's 54611. That's 50992 plus 6119 minus
This
2500.
figure is wrong.
The
Is
51380.
what is the answer?
54611.
54611.
Yes, please.
You scared me because you are supposed to get the premium. I was scared. Hey, so I was thinking even that maybe we didn't add the 2,500. But at the end of the day, you see whether you are correct or not. Because the amount, you see that the premium is 466. If you add it to the 50,000, that should give you that amount. So that is, at the end of the period, you should be paying an amount which is 54. 54611, right?
Yes.
Okay, so what else? The presentation on the statement of financial position and the P&L. So statement of P&L extract, right? Year 1, year 2, year 3, year 4, and then year 5. So I said that effective will go to the P&L, right? The effective interest, and then the coupon will go to the cash flow, which we are not preparing cash flow, and this one will go to the statement of financial position. Let me even use red pen. Oh, red pen. Okay. So finance cost, finance cost. What is the finance cost? Year 1.
4,800.
1,000. Year 2, 576. Year 3, 5,385. Year 4, 5,731. Then the last year, 6,119. Is it not difficult? Is it difficult? Is it difficult?
No.
Which treble voice is that?
Please,
Okay.
Please, is
Please.
Esther?
Oh, okay. Someone said she is lost.
on the
Please, which
calculation
part?
of the coupon, the 2,500.
2,000. This voice looks like Savior. 2,500. So the 2,500 is on the nominal rate. That is why I made a note. The note, you can have to put it in red pen. Why is it that? I have to put it in red pen. Effective interest rate is on the capitalized amount. Capitalized amount is this. And you can send me these two red pens. So by changing to red pen always. This is the capitalized amount. That is where you do some adjustment to the nominal value. So you less the discount and then you less the issue cost. Then you get a 40,000. Effective interest. This is the effect 12%. It's always on the capitalized. That's why we brought a 40,000 here. But when you are doing the coupon is not on the 40,000. Oh, I beg. The coupon payment 5% is not on the first question that we solved. No, fortunately for us, the capitalized amount, there was no issue cost and there was no discount. So the capitalized amount was 10,000, and then the nominal value is also 10,000. It's the same amount. So that's why we were able to get a same, applied it on the same 10,000. Here it is 40,000 for effective, and then the coupon 5% is on the 50,000. That is the nominal or the face value. Nominal rate is on the nominal or face value. Nominal rate or the coupon rate is on the what? Nominal or face value. I believe you are fine now.
Yeah.
So the statement of financial position, you have the non-current asset, liability, sorry, it is a liability. So non-current liability for year 1, for year 2, for year 3, for year 4, and year 5. So the liability, we go to the closing balance. What is the first one? Year 1. What will be for the year 1?
42,300.
42,300.
Year 1, year 10. So what is the name? So loan, right? Loan 42,000. If I say 42,300. That one to red pen and see. 42,300. Let me even remove it from bracket. And I will bracket can 42,300. Second one is what?
44,876.
44 44,876. And then the last one is what?
47,761.
47,761. For year 4, that would be a current liability, right? Year 4, that's a current liability. Why? Because we just have 1 year to pay, so that is a current liability. How much is it?
50992.
50992, and then yeah, this one will be zero. Right? Okay, so that is all for the financial position, and then the P and L, right? The P and L. So I'm not sure anyone has a question. So we move on to the next illustration. Next illustration.
Um, Please, I have a question.
Okay.
Hello.
We are listening.
Okay. Please. So does it mean that, for let's say for the illustration two, the 40,000 will be the fair value that will be recorded at initial recognition?
Come again.
Please. I wanted the value for the initial. Okay. The treatment for initial recognition.
The initial recognition.
Yes, please.
And you are saying that what?
Please. I'm saying, if are you going to use the 40,000, then if you are to use 40,000, how are you going to treat it in our books?
So the initial recognition, we said that if it's a fair value measured at, if it is measured at fair value through P&L, right? The transaction cost will be what? Expense. And then if it's measured through the, if it's not measured, if it's not a fair value, then the transaction cost will be deducted, right? So that's why we deducted the transaction cost, the issue cost. So you're asking, I seem not to get your question.
So does it mean, let's say, if in our books, in the
Mm-hmm.
statement of financial position, financial
Yeah.
liability, and then we credit 40,000?
Are you are talking about the double entry?
Yes, please.
Okay, so for the double entry, um, the opening balance, we would, that is after the deduction of the discount, we would debit our cash, right, and then credit liability. That is with the opening balance in year one, right,
Okay.
and then for the effective interest rate, we will debit it to the P&L. So debiting it to the P&L, that's the finance cost. We debit the finance cost to the P&L, and we are going to credit our liability.
Hmm.
Right? And then with the coupon paid, you will debit our liability and then credit cash. So we are paying with cash.
Okay.
All right. So illustration 3.
Please, I'm reading. Illustration 3. A company issued 4% loan notes with a nominal value of 20,000 Ghana cedis. The loan notes are issued at a discount of 2.5%, and 534 Ghana cedis of issue costs are incurred. The loan notes will be repayable at a premium of 10% after 5 years. The effective rate of interest is 7%. Required: show the relevant entries in the statement of financial position and statement of profit or loss for the 5-year term of the loan notes.
Okay. All right. So we've been given the nominal value 20,000. The loan notes are issued at a discount to 2.5%. The loan notes will be payable at a premium 10% after. So it's basically what you have been doing, right? Can you do it or you solve it? I believe you can do it, right? Can we do that?
Don't ask the question.
Okay.
Please, when the what is the name? In the first question, we were given a cost, issue cost. So when issue cost is given, then we use the second approach.
Yes, when issue cost is given, you deduct it from the nominal value to get the size cost. Sorry, the capitalized amount.
Okay, so that with that one, it doesn't matter if it is premium or discount, or there's a differentiation between that also.
No, it doesn't matter. The issue cost would always be deducted.
Okay. Thank you.
Except that we get to compound interest, where you have equity and then the liability. That's where the issue cost will make some adjustments. You will apportion the issue cost to the equity and then to the liability. But you for now, we will deduct it from the nominal value. All right. So I'm answering question 3 is like the question 2 that we solved. Should we solve it, or you can do it on your own?
We can do it.
It looks similar, but then doesn't mean the premium, the 10% will be calculated on the nominal value.
To be calculated. So the 10% of the 20,000 was 2,000.
Yes, please.
Yeah, so 2,000, 22,000, or plus the coupon payment that you have in that year. So that will be how much? So that will be 22,000 plus the coupon payment that you have. Are you okay? Or you solve it?
So please, that means that we calculate the 7% on the capitalized amount and the 10% on the nominal value.
7% of capitalized amount, and then 4%. 7% on capitalized amount, 4% on the nominal value.
No, 10% on the nominal value.
No, 4% on the nominal value. So that we don't use the premium. Premium, we don't use it. We just use it to compare. From the first illustration,
Okay.
the coupon is the 4% to issue the 4% loan note. So we always use the 4%. From the previous question, you have been using the amount here. Issue the 5% loan note. So you are using that rate. That is the coupon amount paid. The coupon is the rate that counts. This 10%, we don't use it. We are just using it to compare, to know whether what you are doing is correct or not.
Okay.
From the explanation, I think we are okay. And I will solve it.
Yes, we are okay.
Okay.
Yeah, we are okay.
Okay, good. So now let's move to what's that? Special 4. Okay, so a deep discount bond. Deep discount bond, right? Deep discount bond. So a deep discount bond is a bond that does not pay any coupon, right? It does not pay any coupon. So that is a zero coupon bond, right? A zero coupon was bond. So it rather accumulates all the interest and then pay them at the end of the period, right? It does not pay the interest, the coupon, like we've seen from the previous examples. But then it's accumulate the coupon and then pay at the end of the period. So that is a deep discount bond. So let's take this example, illustration 5.4. Deep discount does not pay coupon or a zero coupon, a zero coupon bond. Mhm. Okay, so illustration 4, quickly read that for us.
Illustration 4. The company issues 0% loan notes at their nominal value of 40,000 Ghana cedis. The loan notes are repayable at a premium of 11,800 after 3 years. The effective rate of interest is 9%. What amounts will be recorded as a financial liability when the loan notes are issued? And the second one is, what amounts will be shown in the statement of profit or loss and statement of financial position for years 1 to 3?
Okay. So we have been given a zero coupon bond. It does not pay any interest, right? It does not pay any interest. So what is the amortized cost, right? What is the amortized cost? Um, so here the coupon payment is 0%, right? And the balance CD. The effective interest is what? Is it 9%? Yeah, 9%. So year one, is it year 1 to 3? So 2, 3. What is the balance brought forward? That is the 40,000. You see, there's no issue cost, right? So it's just simple. 40,000. Effective is how much? 9% on the 40,000.
3,600.
3,600. And then the coupon payment, 0. Right? So what will be the amount? This plus this is giving us 43,600. This will be the amount at the beginning. 43,600. 9% interest is giving us how much?
3924.
3924. 0. So giving us how much?
4724.
47.
524.
524. 47524. Then the last one is what?
4277.
42.
Is the effective interest rate
That's what?
4277? That's whole number.
77. So what happened? And the interest is still 0, right? So at the end of the day, how much are we paying?
51801.
518
01.
801. Right. So how much is the premium given? 11,800. So how much is nominal? So 40,000 plus 11,800 is given as how much?
5180.
Yeah, so yeah, because of the rounding effect. So because of the rounding effect. So you could have just done that we could have just got 0 here, right? But even if it's 1, it is still correct because of the rounding effect. You still not correct. Right. So now, how would this be presented on uh, the statement of profit or loss? So P&L extract. The P&L extract is what? Year 1, year 2, year 3. So year 1, 2, and 3. Finance cost. The finance cost. Finance cost is how much? 3,000. 3924 4277. Then the statement of P&L. Statement of P&L. Sorry, statement of financial position. Non-current liabilities. Non-current liabilities. So for year 1 is how much?
43600.
43600. And then this one, we have this one here. Mm-hmm. 47524 becomes a current liability. 47524 and 0. That's all, right?
Yes, please.
Okay. All right, so now let's move on to the compound interest. The compound interest. So compound instrument, right? Compound instrument. The compound instrument has both equity and then a liability, right? Compound instrument. All right, so let me start the compound interest instrument. So what is a compound instrument? A compound instrument is a financial the financial instrument. The financial instrument that has both equity and liabilities, right? That has both equities and what liabilities, right? Okay, so let's look at the example 5, illustration 5.
Illustration 5. A company issues 2% convertible bonds at their nominal value of 36,000 Ghana cedis. The bonds are convertible at any time up to maturity into 40 ordinary shares for 100 Ghana cedis of bond. Alternatively, the bonds will be redeemed at par after 3 years. Similar non-convertible bonds would carry an interest rate of 9.1%. The present value of 1% payable at the end of year based on rates of 2% and 9.1% are as follows. What amount will be shown as a financial liability and as equity when the convertible bonds are issued? And then what amounts will be shown in the statement of profit or loss and statement of financial position for years 1 to 3?
Okay, so with the compound interest, it has both equity and liability. So you can see that this question is a bit different from the ones that we have been solving. And this one is a compound interest because we have a liability, and then this liability can be converted into ordinary shares, right? That makes it a compound interest. So now you have to decouple the equity component from the liability component, right? You have to decouple. You have to separate the equity component from the liability component. From the liability component. So now this is how. So for this one, we need to find the present value of the liability, right? What is the present value of the liability? And I believe you know how to find present value of the liability from your knowledge from the financial management class. How do you find the present value of a liability? Okay, so we use silence to find the present value of what? The liability. All right. Is it not silence? We use it finding the present value of the liability.
You convert the cash flows, the future cash flows into the present value using the effective interest rate or the rate
So
of
what? Oh, okay. But we can. Do you know we can also use the annuity to discount the present value? No, the future value into the present value, right? So we can use the annuity. That is if it's a uniform cash flow, right?
Yes, please.
If it's a uniform cash flow. All right. So if we have been given this, the present value is 1 cedi payable at the end based on the rate 2% and then 9.1% as follows, right? So add the whole of this. Add 0.92 plus 0.84 plus 0.77. What do you have?
$2.53.
2 point what?
53.
53.
2.53. Okay, good. So now this is for the single cash flow. See, here the interest is year 1, year 2, year 3, and they've given us individual cash flow. We can use annuity to find for these 3 years and still arrive at this 2.53. We can use annuity to arrive. So let's use the annuity formula and see. What is the annuity formula? Is it 1 minus 1 plus r exponent minus n all over r? The annuity factor. So 1 minus 1 plus, what is the rate? 0.091. That is the 9.1%. Right? Then the n is what?
3.
Divide by 0.091. What do we have?
2.53.
So you can see that we can use annuity, right? You can use annuity because of the uniform cash flows, right? Okay, that is from year 1, and it's occurring each year. So from year 1 to year 3, uniform. That is annuity. So that is the discount factor. Let's look at the cash flow also. So now, this is just by the way. Let me keep it. I wanted to clean it, but maybe let me keep it. Right, so we have year 1. Yes, we have the cash flows, we have the discount factor, then we have the present value. So we need to find the present value of the what of the liability. We said that this 36,000 includes both the nominal value 36,000 includes both what liabilities and what equity. The 36,000 includes liabilities and equity. So we have to decouple or separate, know the liability part. So if you know the liability component of this 36,000, then of course the remaining will be for what? Equity. The remaining will be for equity. So this 36,000, we want to find the present value of the liability. How much of it is for the liability? Then the remaining will definitely be for the equity. So for year 1, year 2, and then year 3. What is the cash flow? The cash flow is the coupon payment. The cash flow is the what? The coupon. The coupon what? Payment. So how much is the coupon payment? Is it not 2%, right? The coupon payment is 2%. 2% on the nominal value. How much is the nominal value?
36,000.
36,000, giving us a
720.
720. So you see, we could have just, it means every year 720, 720, 720, 720. At the end of the period, we'll be paying the what, the face value plus the interest, right? You'll be paying the face value 36,000 plus the interest of what? 720. You get it, right? At the end of the period, this will be the amount, right? So it's like basically the first one that we did. You see, under the coupon payment side, which is on the face value, we said, do you remember under the coupon payment? Is it under the coupon payment? Look, you can see we have 2,500, 2,500. We can use annuity to just do this. We can use annuity because of the equal cash flow, right? We can just use annuity. So here, that is the same coupon that you are seeing. That's why I took 2%, 2% on the face value. All right. So here, 720, 720. At the end of the period, we'll be having the face value plus the what? Redemption value. Do you remember that the coupon payment plus the redemption value. Do you remember that?
Yes.
Okay.
Yes.
So that we use the discount. The discounting factor has been given 0.92, 0.84. What else? And then the last one 0.77. Right? So find the present value of this.
The first one is 662.4.
662.4. So give me whole number. Let's make it a whole number.
And 662.
The second one is what? 662.
605.
This is what?
605.
605. And the last one is
28274.
2827. So what will be the total?
Please, the total is 29541.
2941. So this is the present value of the debt, right? This is the present value of the debt. But how much is the face value? How much is the total face value?
36,000.
This value is 36,000. So what do you add to the present value? Get a 36,000. Find X. So that amount is known as the equity. The difference is the what? Equity, which is how much?
6459.
6459. We can also use the annuity. Let's use the annuity. So this same answer that I've gotten, I want to use annuity or annuity. Using the annuity. So someone can just use the annuity formula and finish faster than you that you are going through all this process. Just about 3 steps. You all will be getting the same answer. Just about what? 3 steps. So here. So I think this is what we are doing in F. This is what we have been doing in F. I think last week we used that, right? So we have the year, the cash flow, the discount factor, and then the present value. So from year 1 to year 3, that is annuity. What is the cash flow? We will be paying interest of 720. That is the interest. The interest every year for 3 years, right? So you can see here 720 for year 1, 720 for year 2, 720 for year 3, and the face value at the same year 3. So 720 3 years, 1, 2, 3, and the 1, 2, 3, 720. It is annuity because it is. So let's use the annuity formula. When you use the annuity discount, what did we get? We still had the same amount, right? 2.53. Right? We still had the 2.53, right?
Yes, please.
So this same 2.53, 2.53 times the present value. Can you give me a 3 decimal, please? Using the annuity, what answer did you get? You give it to me. You do this one, you have 2.35. Annuity, can you just leave it?
27.
2 point what?
527.
2.527. Okay. So if you run it, I still get. I just want to use 3 decimal place. 2.527.
And
So if you multiply, what I get?
1819.44.
You are getting
19.44.
18.4, 1819. That is multiplication of, this is 2, right?
Yes. 2.527 times 720.
yeah,
And it's giving
181.44.
okay. Then you can see the third year. The third year is what the face value, right? Which is the 36,000. Do you remember this? What discount factor would you use here? I previously said we use the single amount discount factor, right?
Yes, please.
We said the single amount discount factor. What is the single amount discount factor for year 3?
0.77.
77. So that one would have done 1/1, 1/1 plus 0.091 for 3 years, and that should give you 0.77. So 0.77 times this, what are you getting?
27720.
2770.
20.
So when you add it, what are you getting?
29539.
295
39.44.
39.44. So you can see that there's a slight difference, right? There's a slight difference because of the rounding. Make it 3.5, let's see. Make it 3.53, let's see. Let's change this one. Now make it 2.53. 2.53.
1821.6.
182 21.6. Yeah, man, now 222. Right? So add it and let's see.
29542.
292.
29542.
29542. 542. Yeah. And what is the face value? 36,000. Right? So the equity is the present value of the debt. And the equity, what's the equity?
6458.
6458.
58.
So you can see that there's just okay, this 59. That's the fully different because of the rounded effect. So if you had used annuity, you still get the same answer. Right? If you use annuity, you are getting the same answer. If someone can use you just right. So assuming it's 1 to 10, are you telling me you write 720, 720, 720, 720? By the time you finish, the one using annuity will that's it. So this annuity, I believe you can attest to the fact that we have been using it in the financial management. Year 1 to 3. I think just last week, right?
Yes.
Yes. So you have to under financial instruments, you have to so that it is the same assumption, same principle. Right? Now I've gotten the equity. Now I've gotten the equity part. So what is next? Now that you have gotten the equity, what is next? We are going to amortize the what? The liability component. Amortized,
Um,
that is the present liability, present value of the debt. Amortized.
please, please, I want to ask a question.
Your name.
Please, does it also mean that
Who is
when
asking the question?
Beatrice, please?
Okay.
Please, does it also mean that when the number of years, let's say, is year 1 to 5, and we are using the annuity formula, we will do it year 1 to 4, then we use the value. Then year 5 will be the nominal value.
The interest rate is for the whole period. The interest or the coupon. The coupon payment is from, assuming it's from years 1 to 5, the coupon will be paid throughout all the years, throughout the period. So that will be from year 1 to year 5. So 720 up to 5. Then plus the face value.
That's only for year 5. The face value will only be for the year 5.
Yes. So assuming it's for year 1 to 5, I would have said 1 to 5, and then this one will be 5. So I'll find the discount factor for 5. So 1 over 1 plus 0. Let's say this, or exponent 5. Then I'll get this discount factor. Then I multiply it. Do you get it? Hello. All right. So let's continue. So under amortized cost, but can you hear me?
Yes.
Yes,
Yes.
please.
Okay. So for year 1, balance brought down. Then we have the effective interest still at the end, coupon paid. Then the balance. So the question says arrears. This is arrears. If the question is silent, we still assume at the end, right? If at the end. If it is at the beginning, I think I've showed you earlier how you are going to do it. How you are going to do it. And with that one, because you have made the interest at the beginning, the subsequent years you have, let's say if it's 1 to 5, you now have 4 years. When I'm doing the discount, it will be exponent 4, because at the beginning you had already paid the interest at the beginning, so the remaining years is 4 years instead of 5 years. That is at the when the question is payment in advance. Payment in advance. Note that the number of years will no more be, example, 5 years. If it's 5 years, the number of years will no more be 5 years. It will be 4 years. So use the 4 years in your computation. In your computation, because it has been paid in advance. Payment in advance, right? So now this is the amortized cost for year 1, 2, and 3. Balance brought down. What is the balance brought down? This is the balance brought down, right? This is the balance brought down. So balance brought down will be 29. 4. This is for the liability. Amortized cost is for the liability and not the equity. You see, now we have separated the equity from the liability. We have separated the equity from the liability, right? So now this is just for the liability. We are doing amortized cost. Do you have issue cost? Do you have issue cost here? Any issue cost?
No, please.
All right. Assuming we're having issue cost, let's say issue cost of 1,000. Pay attention. Assuming we are having issue cost in the question, issue cost of 1,000. The issue cost, I won't say that I'm going to deduct it from the present value of the debt, that I'll deduct it minus 1,000 issue cost because I want the capitalized amount, then I'll deduct it. No. You have to share the issue cost for both the equity and then the present value of the debt. You will share that 1,000 for them. So how do you apportion it? This is 29542 over 30 out of the total. The total is 36,000 times 1,000. For the equity, you to take yours. Equity will be 6,458 over 36,000 times the 1,000. So the issue cost, if there is issue cost here, you are not going to give it to the debt because from the previous one to get a capitalized amount, we deduct it from the nominal value or the debt or the face value. Here you share it for them. You apportion it for them. You are going to apportion it for them. If there is an issue cost, apportion it to the or for the equity and then the liability. And I know you know how to apportion based on departmental accounting. Where you are going to apportion the expense. Your fundamentals of accounting, departmental accounting, you know how to apportion. And I've even demonstrated it here. Okay. All right. So now, what is the effective rate? Effective interest. The effective was what?
9.1%.
9.1%. Know that. So I think when we're doing the computation, we use the effective, which was the 9.1%. Right? We use the effective rate. This is the effective. This is the effective 9.1%. That's why we are using 8 figures. We are using that for the effective, not for the face value. We will not use the face value rate. So someone will say, why is it that we didn't use these values? Look at the right hand, the question. Someone will say, why did we use these values? We are using the effective values, not the face value values, right? Okay. So now let's continue. The effective, how much is it?
2688.32.
Good number. 2688.
Yes, please.
Point what?
32.
Good number. What will be the coupon? Coupon.
720.
We've already computed it. 720. Coupon is already 720. So what is the balance?
31510.
𝑭𝒏𝒔𝒕𝒓𝒄𝒊𝒂𝒍. So that will be the beginning here. 𝑭𝒏𝒔𝒕𝒓𝒄𝒊𝒂𝒍. And interest on it is how much?
2867 whole number.
2867. But then the
33657.
33657. Then for the last year,
3063 whole number.
okay. And 336. Is that 6 what?
57.
Interest.
3063. $36,000.
Sorry, 36 what?
Thousand.
Yeah.
Yes, please.
Mm-hmm. So have you done?
Yes, please.
Okay. So what's next? You want to show it on the what? We can show it on the P&L, right? Where the P&L extract. So P&L for year one, year one, year two, year three, right? The finance cost. The finance cost.
260.
260, and then the 867, and then 3063. And then we come to what? We come to what else? Financial position.
Hello.
Ah.
Is that Philip?
Yeah. Yeah, I'm listening.
Is the effective rate? Why didn't you use it individually?
I said that. Is that what?
Asking why I'm asking why you didn't use it individual, like year one, then use the 0.92, year two, then use the H rate.
And we use it in getting the what yeah, we use it in getting the present value of the debt. We use it in getting the present value of the debt. That is the essence. If you don't want to, you can even ignore it and use the annuity. You can even ignore it. So here I demonstrated that using it, you are still getting the present value of the debt. Then you can ignore it and use your annuity. Why? Because it's from year 1 to year 3. So assuming they didn't even give you this question, you should be able to do your thing, right? They didn't give you this one. Assuming they give me this one 1 to 10, so I'll follow what they gave me. No, because it will waste my time. If they gave me this one maybe from year 1 to year 10, then I'll say, okay, do it 1 year 1 to year 10, 720, 720, 720, 720, 720, 720, 720. By the time I finish, someone, when you see that annuity will finish and then leave you, then you still be on one question, right? So that you still be on one question. So that amount was just, but not here we are finding the effective rate, which is 9.1%, right? The non-similar convertible bond would carry an interest rate of 9.1%, right? The 2% represents the non-convertible or the nominal value. The nominal value. Right. So still on the non-current liability. Non-current liability. Non-current what? Liability. So what's the non-current liability? Non-current liability would be what? So that would be 31,510, 31,510, 31,510. They are doing all nine too. All nine. Right? So did you bring your offering?
No.
You are coming to church.
Don't be nothing.
Eh? You are coming to church, you didn't bring your offering. Really?
Instrumental is in your
We have
you ever going to mama with only scanaba.
Oh, okay. I see. All right. So then year two will be what? It will be 33, 6, 5, 7. We just have 1 year. So I think that will be E for current liability. And will that be for current liability, which is 3, 6, 5, 7. Right. 3, 6, 5, 7. Why did you even bring 36,000 here? Eh? Is it not supposed to be 0? Okay. What else? So that is it. That is it. Then the last question. So the last question is an assignment. And please, for this assignment, I've been giving you assignment, but you don't submit it. But for this one here, I want to, guys,
Beg.
why do we, why is it so cheap? So I'm begging that I should give you a more complex one.
Hey.
For this one, it's not the same thing. Issued 5,005% convertible potentials at 100 cities, right? At 100 cities. So, what is the face value? You get the face value. The face value is it 5,005% 5% convertible preference shares. So it means this 5,000 is preference shares issued at 100 cedi per share. What is the face value? Face value is 5,000 shares at 100 what cedis. 100 cedis. So how much would that be? Add the zeros. So 500,000. So 500,000. That's the face value, right? What will be the cash flow? The cash flow for the coupon payment. The cash flow for the coupon. The coupon is 5%. Issued at 5% on the one on the face value. 5% on the face value, right? So how much is that?
25,000.
25,000. This is what I'm saying, that you can use the annuity. This is the cash flow. So if you are, and this one is a compound instrument, but it will be converted into what? Shares, bond, which will be converted into ordinary shares. So it has both equity and then liability. So it means the 500,000 includes equity and liability, equity and liability. So that's the couple. Or let's separate the equity from the liability. So that's we are going to use. We are going to find year one cash flow, discount factor, and the present value. I'm going to find the present value of the debt. Present value of the debt. So what's the present value of the debt? Present value of the debt. Year one, how many years? For year two, how many years? From January 11 and then 1st January 2016. That's 5 years, right?
Yes, please.
That's yes. We are going to do all this for 5 years. Well, we can use annuity to do it. Look at the cash flow. 25,000, 25,000, 25,000, 25,000, 25,000, 25. The last year we'll pay the 25,000 plus the 500, which is the face value. Right? The last year we'll pay the 500,000, 525,000. That is the last period. Then the discount factor will be for year one. You do 1/1 plus 0 point. What is the discount factor? The prevailing dividend.
6%. Hey, sorry.
Issue corporate and the shares have been blah 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 of the blah 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 blah. Dividend of shares have been paid and the prevailing rate for the similar instrument conversion that is 6%. Is it 6%?
Yes, please.
Let me see. 1/1 plus
Please, year one is 0.94.
0.94.
Yes, please.
Give me 3 decimal place.
0.943.
Okay, year 2.
0.89890 3 decimal place.
Mm-hmm.
0.840.
I'll just use my annuity and go. 3 steps. 0.8 what?
40.
0.840. Even this one cries risk. If you are not careful, you're going to punch wrong decimal. Are doomed.
0.792.
0.792.
And 0.747.
And then 0.747. Right. So we multiply them. I believe you are aware you are reading this discount factor. This is the 6 then n.
Yes, please. This is the present value for year 1. 23575.
3575. The rest, are you sleeping? Take your calculators and punch.
Year 2. 22250.
2, 2, 2. Someone will be punching point. Year 5, year 3, year 4. 2, 2 was 50.
Yes, please. Year 3. 21,000.
1,000.
Year 4. 19,800.
19,000.
Year 5. 392
392.
175.
175. Give me the 2, 2.
Please, I had 478800 as a present value.
478
800.
800. That's the
Yes.
present value of the liability. So, what is the total face value?
500,000.
The face value is 500,000. So, what is the equity component?
21,200.
1,200. Now we use the annuity. Let's use the annuity. Annuity. What is the annuity formula?
1 minus
So, from year 1 to year
5.
first flow, discount factor. Year 1 to year 5, right?
Yes, please.
That'll give us amount.
The cash flow is 25,000.
The cash flow is 25,000. And using the discount, the annuity. Annuity is
4.22.
all over R. What are you getting?
4.212.
So 4.212. 212.
Please, I had 105,300.
105.
300.
300. Then for year 5, the face value, which is 500,000. This you use the single value 1 over. Do you know that?
Yes, please. Please, the discount factor is 0.747.
0.0.
0.747.
So you multiply, what I guess?
373500.
373500. Add it, what I get?
478800.
478800. Can you all see it's the same as this?
Yes, please.
Look at the step. Just this and this. I'm getting this amount. Look at the step. Look at what you feel at the top. If you are not even careful, you might even write, instead of 0.8, you write 0.9. That will make this answer wrong. See the rate? I didn't think you want to use the first one. No problem. If you think you'll be fast. Well, because annuity to means if you make a mistake with the formula and you don't get the annuity formula properly, it's fast. At least this one they will mark your if you didn't get this one. I think this one will be correct and this one, right? Since accounting the mark takes. Okay. So that will be 21. Right, so what is the name? This is what the face value. So now what I was saying is that in this question, do we have total issue cost? Yes. We have total issue cost. Total issue cost of what? 40,000. Right, so the issue cost, if you want to get for the liability, so for the liability, what did you get? 47800 over the total, which is what? 500 times the 40,000.
Sorry. Please, the first one is 38304.
Hey, I don't think you have one chance.
Easy. No more better me cry.
What did you get?
38304.
38304.
And that of equity is 1696.
1696. Okay. So sum these two. If you sum these two, are you getting for 40,000?
Yes, please.
Okay. And we said that we will apportion them. Now we have liability part and then the equity part. What is the actual liability that will be amortized? The liability that will be amortized will be, what is the amount? Liability amount is what? 478800 minus the 38. So this is the issue cost. The issue cost 38304 will be deducted from this amount before we are going to amortize it. And then with the equity to the equity 21200, right? 21200 minus 8 issue cost. 8 issue cost is how much? 1696. So how much?
The capitalized, the liability is 440496.
440.
496.
Then this one is what?
19504.
9504. Right. So this is the amount for the liability. This is the amount we're going to amortize. And the equity to this is the equity that is sent to the financial position. The equity that is sent to the statement of financial position as equity. And so the amortized cost, now we are come to amortize. Make the payment. Come to make the payment of the liability. So year one, balance. This is not difficult. You just know the principles. And then I just effective interest. What's the effective interest here? 6%. Then coupon payment. Then the balance. I think they just know the principles and you are good to go. Are good to go, right?
Yeah.
So what's the effective interest rate?
26430, whole number.
26430. Okay, then coupon payment.
25,000.
And then the balance.
Four 926.
44196. So you have the year two. 44196. So go and continue at the house. Go and continue. On that note, thank you very much for coming.
You are
And
well.
enjoy the rest of your evening and make sure that you revise whatever we have done. Make sure you go for tutorials too. I'm sure tutorials, you have been solving the tutorial set questions with you at tutorials, right?
Yes, please.
Yes.
So I think some of you, very few of you have not been attending the tutorials. So Herbert, you keep the answers for the tutorials and then share it with them. If you share it with them and they still don't understand, I'm sure. But you guys met last week to do some discussion.
Yes, please.
Yeah, so it means you'll be meeting regularly to do some discussion. So whatever you did on the tutorial, just go through. I think from opening your eyes here, maybe the tutorials, he just came to solve the question and then leave, of course, which is what sometimes they do. I don't think the tutorials time will allow for them to go through the explanation much into detail, but that is why here I'm opening your eyes, I'm opening your mind, know the general principle so that you can go back to the tutorial and say, like, oh, okay, that is why the TA wrote this and that, right? So, let me see. So,